So, what is going to happen to home prices in 2022? Well, 2020 and 2021 were pretty doggone amazing years. I mean, here in Phoenix, home prices are up 33% across the board. And of course, the marketplace where we play, where our wheelhouse is at, we're in the entry level. That entry level has gone up much better than 33%. We've had some amazing increases in these homes. And here in Phoenix, our entry level is now pushing $400,000. As locals, we think this is absolutely amazing. And we wonder to ourselves, how much higher can prices go? Are we peaking? And of course, here in Phoenix, we were the poster child for the 2007 debacle, the housing bubble. So everyone has kind of been burnt and shell-shocked. They don't want to do that again. However, I think we are going to go much, much higher. My model is saying that. Everything I'm looking at, all our research is saying prices are still going up. Now, you have to remember that we are local, and we need to look at this from a regional and a national basis, actually into an international basis. And I've been in business for so terribly long. We want to look at this and say, what was it like last time? Well, if you remember, in 2001 and 2002, prices had been stable for years and years and years. Maybe they're climbing 1 or 2%. It was kind of a slow ride higher. And then all of a sudden, things started getting higher. And in 2003, people had made a pretty good return on their homes. And a lot of locals started selling, saying, oh my goodness, I've made a lot of money on my house. I'm going to cash in. Kind of like buying Amazon. It went from 30 to 100, and they said, oh my goodness, I'm going to cash in while I can, not knowing that Amazon was going to go considerably higher. Or Tesla. Tesla went from next to nothing to 350, and everybody thought they were rich. Little did you know it was going to go to 1,000 and beyond. So this is what we need to start thinking, is that locally, our prices are high. Nationally, our prices are fairly average and are very reasonable, particularly in light of all the industry and all the business and all the in-migration we got coming in. And our models are telling us home prices are going much, much higher. Remember, our models tell us what, they don't necessarily tell us why. So on our barometer, we think home prices are going much, much higher. Let me go to my next slide, and let's talk about a couple reasons why. Well, nationally, there's a housing shortage everywhere. Nationally, we have homes in the wrong spots because we have demographic shifts. We have immigration. We have millennials pushing into the pressure. And of course, we have a 5 million home shortfall that the builders are desperately trying to make up, but they're running upstream. Now, everyone is making a lot about immigration, whether you're for it or against it. It's a fact that an awful lot of people just immigrated into our country, almost 1 million people. All those people are going to need a place to live. Now, what homes they take, I'm not quite sure, but they are going to take housing units, and it's going to put more pressure on. We've also, in previous videos, discussed the fact that the millennials, which are bigger than the baby boomers, 95 million strong, getting married. They're going to have babies, just like we are. They're going to want to have a backyard with a swing set and a sandbox. Their kids can throw a ball, and they'll become adults and families and parents. And there's 95 million. They're actually larger than the baby boomers, so they're really going to affect the housing industry, and the builders are struggling to keep up. And we have this demographic shift. So we have housing in the wrong places in the country. We've got shifts. We've got 4 or 5 different trends, which we've also talked about. But just thinking about the baby boomers and those retiring, when they retire, they want to get out of the cold weather and go into the sun. So we're having a lot of people shifting to the south. They're going to Florida, Texas, and Arizona. And again, we have housing pressure in these major markets, and we have houses in the wrong spot, because if you got plenty of homes Waukesha, Wisconsin, or Fargo, North Dakota doesn't do any good when people are moving to Scottsdale, Arizona. And consequently, they're driving prices. And we're here in Phoenix. We're in one of the major markets of the United States. Home prices are being pressured by demand, let alone the trends. The demand is pretty doggone awesome. So we're seeing housing units get built, and we're seeing rental units get built, but they're being filled almost immediately. Prices are going up, expenses are going up as well. So here in Phoenix, our average rent is running around $1,900. That's historical for us, but if you're coming from California, it's dirt cheap. So it's all relative, and we need to think on a national basis. Let me go to my next slide. We can take a look at that. Now, this is the last price. Now, we track these. You can see here that we had this is when a COVID hit. We came down. This is the recession, and immediately right after that, we just came right up. So housing on our charts is still very, very strong. Now, this is coming right out of Zero Hedge, and you can see that it's slowed down a little bit. A lot was to be made out that it slowed down just a little bit, but it's been working its way higher. And of course, we're looking at a lot of seasonally adjusted increases, and we're seeing lots and lots of properties being sold at much higher prices. There is no slack in our demand. Now, we just received this. Media made a huge deal out of the fact that home prices slowed. Home prices went down. Well, home prices went from an appreciation rate of 19.09 to 18.41. They dropped like 0.65%. They dropped almost less than 1% change in direction. They're still appreciating at 18% a year, not 19% a year. It's still pretty doggone good to be an owner of properties. And if one's good, two's a lot better, 10 is really good. And if you have 20 or 30, you are making a lot of money. And I don't see any slowdown in the appreciation. So let me go on to the next one. So far, so good. No reason not to continue buying. No reason to think that we've peaked. No reason to think that a crash is imminent. No reason to think that prices are coming down. No reason to think that rents are coming down. To me, it looks like they are all going to continue higher, higher, and higher. Much, much higher from where we are. Now, we've talked about my real estate cycle. This is based on a repeating cycle that we've had till pre-revolution. You can look all through the internet and find all kinds of things. This is something you can do yourself if you'd like to. But I think we're right here. We're just finishing the accumulation phase, and it's been exactly true to form. Now, I want to do a little CYA here. And this is a model. The model works until it doesn't work. So far, it's been deadly accurate. But nothing says that it has to continue to be accurate. But so far, it's worked really, really well. And they give us little signposts along the way. And I think we probably will be finishing going into the accumulation phase, where I think we're going to start going into the explosive phase here in 2022. And I think that's going to just drive home prices much, much higher. Now, as you know, Charles Nenner and I interviewed Charles Nenner. If you look at my videos, now Charles Nenner is one of the world's top cycle researchers. He's been uncanny in his predictions. He has a huge following. He's just absolutely brilliant, man. He sent me this. This is the Toll Brothers chart, and what it is, it's a proxy for the real estate industry. He sent this to us. Please don't reproduce this. This is his proprietary work. But if you look at this, this is telling you this dotted line is January 2022. That's where he thinks the bottom is for Toll Brothers. From there, he thinks it goes even higher than where it is. That means that we've got a little bit of a slowdown coming, a little bit, and I think we have that now. We've talked about the fact that we think that the economy probably will slow down. It was on fire. It was at an unsustainable level, and now it's going to slow down to a sustainable level. And is it going to slow? Yes, it's going to slow. Is it going to stop? No. I don't see anything that says that the economy is going into recession. It doesn't look like it's going into a negative territory. It's just slowing down to a more sustainable level. Now, of course, it bears watching. We always pay attention to this, but I don't see any reason for concern at this level. And based on my model, and thank you, Charles Nenner, for sending me your slide. Charles also saying that his proxy also looks like 2022, the first 4, 5, 6 months of 2022, probably going to be pretty doggone good. So we're looking at 6, 7, 8 months. I think that we see a much, much higher prices, a very, very strong housing economy, and very, very good for us. So how do we do this? How do we take advantage of what we see is going to be a very, very strong market for housing? You want to be in this market. This is a market that you want to participate in. How do you do that? Well, you're always welcome to call us. Now, we're in the great markets of the United States. We are very, very good at this. We'll help you any way we possibly can. We'll talk to your spouse. We'll talk to your financial advisor and see what we can do for you, because these are your properties. We're here to help. Let's go to my next slide. Now, I think in the next 5 months, you're going to have a great buying opportunity in the housing industry. Now, you can see the charts. They just look like they're poised to get better. So go buy a house. If you don't own a house, go find a broker that's going to help you find a house. Go buy a house. All the National Association of Realtors studies show that those people that own houses have 10 or 20 times more equity than those people that don't. So get off the rent, go buy a house. If you think that one house is good, 2 is better. And if you're getting ready to retire, we like to see you have at least 2 rentals in your portfolio, and that's to protect you for inflation that we also see is coming. Follow our work. If you look at our work, you'll see that we've got inflation coming as well. That's one of the other things. Now, I have some CYA. I am a licensed real estate agent here in Arizona. West USA is the firm that holds our licenses. My group is very, very good at what we do. We are all licensed through there. West USA is like a $5.5 billion firm. They know exactly what they're doing, and we are very, very good at what we do. You're welcome to call me at this switchboard and reach us. And if you like what we're talking about, follow us on the internet with our videos. You're welcome to subscribe. If you like this video, please give me a thumbs up. And you're welcome to reach me at michael@michaeldouville.com. My business plan is in how to create a real estate money machine and retire with income. That's a plan of just buying one house every year. It's kind of like dollar cost averaging. You know, some years you pay more money than the other years, and once in a while you get a break and get a really good buy. But in the meantime, you're accumulating assets that appreciate and give you cash flow. It's a very, very good program for retirement. If you're just getting ready to retire, we can do this in 4 or 5 years and really, really make a huge, huge difference in your lifestyle going forward. And if you want to come into my seminars, this is what we teach, real estate investing for beginners. You're welcome to reach us and ask. We're going to be having classes. So my very, very best for you. If I can help in any way, just give us a call. My very best. Bye-bye now.